Welcome to the daily update, where I'll go over the action in the market for Friday, September 27th, and then we'll see how things look for Monday, September 30th. Started off pretty positive, and the broad market held up better. We saw some weakness in the mega caps, and that pulled the indexes down. We didn't really jet to the upside, but at the same time, this Hindenburg almond and the weak seasonality, that really hasn't developed either. So we still are positive in the short, intermediate, and long term. We have these negative things in the background that we just want to be aware of, but we're not seeing confirmation in the charts, at least yet. There is a thing called the SPXInvesting Program. It's up, it's going. I post additional videos there. It's a program that I have. If you want to learn more about that, there's a link that will take you to the website as well as to a video that will tell you more about the program. If you have any questions, you can email me. One of the benefits is you get access to the videos as soon as they are prepared and uploaded. The daily video is the real foundation of the analysis that I do. Now that it's the weekend, I'll be preparing all of the outside videos, but really it's the daily video that will really help you get some insight as to what's going on. Let's go back and talk about what happened and then look at some charts. We did have a higher open. There was some positive reaction to the core PCE that came out, but it didn't last very long. After the cash session opened, we saw some selling into strength, but not real intense selling. Prices topped out at around the 57.60 level. We never even got up to R1. We just stopped at kind of a round number area. Then we declined down to the daily pivot at 57.45. We stabilized around the daily pivot for a while, but then we declined instead of bouncing back up. And we declined down to the 57.30 level. Again, another round number. We didn't hit S1, but we couldn't rise back above the daily pivot, and we closed slightly lower on the day. We were down 0.13% on below average volume. There was a lot of anticipation about the core PCE report coming out, but it really didn't lead to much. It was friendly, but it didn't bring in a lot of buyers. We have to kind of wonder, are the buyers being exhausted right now? It could pick up again, but just something to think about. And we are positive in the short, intermediate, and long term. Inflation still seems to be under control. Interest rates are continuing to drop, at least in Friday's session. That often helps stocks. But we want to keep an eye on all the different geopolitical things going on, specifically right now in Israel, if there's going to be an escalation beyond what is already happening. We ended up having a mixed session with tech and mega caps weaker than the broad market, and that could also be encouraging. The fact that the broad market's holding up better. It's not just a few stocks that are driving the markets either higher or lower. Now, they have an impact when they don't really have a good day, or they have an impact when they do have a good day. But we're seeing like the NYSE and the rest of the S&P 500 actually holding up quite well. We do have a confirmed Hindenburg almond. So far, it hasn't meant anything, but it could. The same thing can be said about the weak historical seasonality. On a short-term basis, a little bit shorter list now. We have the Stochk RSI, Williams percent R, the CCI 20. The 14 is still not on the list. The slope oscillator and the stochastics are extreme positive or showing good momentum. Intermediate term, the 50-period exponential moving average, the PMO studies, the Sean trend meter, the bullish percent index for the S&P, that just keeps going up, and it can't even, it's getting to the top of what it can go to. So we'll look at that chart. The money flow, the 10-day average of the new highs, new lows for the S&P, and the 100-period moving average study of those stocks inside of the S&P. And our longer-term moving averages, but again, this could also be taken as positive, the 150 and 200-period simple moving averages, the exponential moving average on the S&P itself, and the 200-period moving average study of those stocks inside of the S&P. We haven't changed the scenario because it appears like the soft landing that the market is anticipating seems to be possible. So nothing has really come along to put that in doubt, at least as of yet. The dollar was down and interest rates were down. We closed at 3.75% with the 10-year yield, where we had been at 3.79%. We're still inverted with the 10 to the 3-month yield curve, but we're still uninverted with the 10 to the 2-year yield curve. We did tick down as far as sentiment is concerned. We got up to 72, which is kind of around that 75 level. We ended up being still positive, but we ticked down to 68. We're still positive with our trend. The ADX is above 20, above its moving average. With the slight down day, our bias is negative and our momentum continues to be positive. So here's a long list, and I don't have charts of all of these. I'll just go through some of these numbers. The advanced international trade in goods balance came in at minus 94.3 billion. That's less than the minus 102.8 billion we saw last time. Advanced retail inventories were up 0.5%. Last time they were up 0.8%. And then wholesale inventories were up 0.2%, less than the 0.3% we saw last time. This was the more important part of the economic reports. Personal income was up 0.2% month over month, less than the 0.4% that they expected, and down from the 0.3% we saw last time. Spending also came in less than expected, up 0.2%. They expected it to be up 0.3% and down from the 0.5% we saw last time. The PCE price index was up 0.1% month over month as expected, but lower than the 0.2% we saw last time. This is kind of the big one. The core PCE, which takes out food and energy, was up 0.1%. They expected it to be up 0.2%. Last time it was up 0.2%. On a year-over-year basis, the price index was up 2.2%. Last time, the year-over-year calculation was at 2.5%. And the core PCE price index was up 2.7% year over year. Last time, it was up 2.6%. Consumer sentiment came in at 70.1, a little bit higher than the 69 they had expected. And that was the reading that we saw last time. And we look at this on a year-over-year basis. So a year ago, it was at 67.8. So a little bit of an improvement there. Here is the personal income and spending. We look at spending in blue, which is really flattening out here. And income is coming down, but also flattening as well on a year-over-year basis. The core PCE inflation year-over-year is actually turning back up, but it's still below that 3% level. We're getting just a little bit above the 2.5% level there. On a month-over-month basis, spending was positive, but decreased from the previous reading. Here's consumer sentiment, where it came up to 70.1. A little bit of an improvement. We also plot that with the 2-year treasury, which has been coming down as far as the yield is concerned. And then looking at consumer sentiment, the blue line, that's the reading that I have a chart that I'll show you next. It's showing a little bit of an improvement. People are feeling a little bit better with the purple line. That's how they are right now. And then looking out into the future, that's yellow, also seeing an improvement there. And apparently the chart, okay, I already showed that chart. Here's some Isabel Net blog charts here. The effective Fed funds rate, the 3-month average, and then against the S&P. This is mainly just historical, going back into the 1950s and just different times along the way where interest rates were flat, but the market kept going up. There's other times when interest rates are going up and the market goes up. Then there's other times when interest rates are going up and the market's going down. So we have to know the context of what's actually going on here. 42 new highs for 2024, going back to 1957. That's just showing a pretty good reading right now. And at least that's to this point. We'll have to see if any more are generated going into the end of the year. And I don't really cover gold other than just looking at it here, but it says stretched prices usually mean meager near-term gains. We've seen gold really going up, and this chart just shows that when we've gone up too far too fast, people tend to chase it after it's already gone up, and then they're disappointed when it doesn't keep going up really strong like they thought it would when they got into it. And corporate revenues are growing at a historically average pace, so we're still looking pretty good there. We're positive, and that justifies higher stock prices. The cash allocation is now at 11%, which is down a little bit below the 12% average level. And will private investors return to gold? And we have gold really going up right when the Russia-Ukraine war started. And private investors are starting to come back in, but it's mainly the institutions and central banks, from what I've been able to see, that are really getting into gold. But this is measuring the gold ETF, which trades like a share of stock. US mutual funds and ETFs, this is the assets under management breakdown into equity, bonds, and money markets, where most people are in stocks or equities. Then it's tapering off here, a lot less, but there are bond mutual funds and ETFs that you can belong to. And then money markets are actually going down. So we're seeing these areas going down. Even though bonds have been doing well lately, stocks continue to be the favored type of investment. I didn't spend any time on Twitter. I'm still in vacation mode here. So we did have a higher open. We did get up to the 5760 level. That's pretty much where we topped out. We went a little higher, but just could not break above that. So we came back down to the daily pivot, danced along that, broke below it, came back up above it, and then we finally broke a little bit lower, but we didn't see any real follow through there. Came down to the 5730 level, then back up to the daily pivot and closed down a little bit below the daily pivot. And nothing really all that major as far as the intraday chart. We're still a little bit concerned about this because the red line's above the blue line and value was up where growth was down on an intraday basis. And this is a little bit of a concern too. We need growth to see more follow through for the S&P. It actually declined, and we've been going sideways lately with this ratio. So end of day growth was down over 0.5% where value was up. Mid caps, it was up, but up less than it was for value, and it was up a little bit more for the small caps. So saw a little bit of a turn down here with our end of day chart. We want this to go up if we're more positive on the small caps. Turning down, also want to see more follow through here with the mid caps than what we're seeing. And coming back down after we had been looking a little better with S&P growth of value, it's declined over the last couple of sessions. And we're coming back down into the lower end of the rainbow when we look at the growth of value ETF. This is still encouraging, though. The discretionary to staples ratio continues to go up. And for most of 2024, this has been the real disappointing area. This is actually looking a little better right now. Large cap growth was down over 0.5%, but still above all the moving averages here. Our trend is positive. We're above 20. We're above the moving average. So now it's a confirmed trend. It's positive because the green line's on top. It did decline slightly with the down day. The short term also declining with the green line, but we're also in a short term confirmed positive trend. And we dropped off now with volume, with our volume oscillator here. Sentiment, we went up with the VIX on a closing basis as well as the bar chart. When the VIX goes up, the VIX of the VIX also goes up. We're coming back up to the moving average here with the bar chart and just under the moving average here with the closing value of the VIX of the VIX. We're turning back up a little bit here, but the momentum for the VIX still continues to be down. Historically, we will typically see the VIX going up during this time of year, but it just really hasn't developed as stocks have been going up. Still getting a very high reading with the skew index, so that's still meaning that the market is expecting some kind of a big move, whether it's going to be to the upside, that's what our charts could suggest, or it could be to the downside. That's what the Hindenburg-Ullman and seasonality could suggest. We ticked down a little bit with this fear gauge, and we also declined with the other fear gauge. So a little bit of a discrepancy between this and the VIX. And we declined about 0.5% with the risk on to risk off ratio, but overall this has been going up, and that's more positive for stocks when it does advance. Ticked up a little bit here with the equity put call ratio daily chart, and we're still getting an extreme negative reading with the 5-day chart. Here's another longer term look at the 5-day chart as we go into that extreme reading. And we could still go lower than this, and we continue to decline with the 10-day chart. We look at the ratio between large caps and small caps. We were down a little bit as small caps had a little bit better day. Not really seeing any real conviction right now. We're just chopping more or less sideways here. Not seeing a real pickup in the volatility risk premium. We're still below the band area. Looking okay here with the advanced decline line. Even though the S&P was down, we actually broke out to a new high based on price. And we are doing pretty well based on volume because it was the big stocks that held the S&P back. The rest of the S&P actually had a better day. And we saw some new highs, not really any new lows. We're rolling over a bit with our 5-day, and we're starting to decline with our 10-day. And that's because we're seeing more of a contraction in the new highs, not necessarily an expansion of new lows. We're still looking positive, but declining slightly with accumulation distribution. The boom indicator still suggests that we're kind of far away from that moving average. We ticked up a little bit here with the advanced decline ratio, and we are positive. We're positive based on price, and we're also positive based on volume with the advanced decline 19-day ratio that we follow. We were flat to a little bit better here with the chicken money flow. So this smart money indicator is holding up fairly well, even with the down day, but we're still declining with the chicken oscillator. And we're going up with the vortex, but we're going down with the red line with the vortex, but it's getting to an extreme reading. And looking okay here with the cumulative S&P 500 advanced decline line based on price breaking out to a new high and based on volume also breaking out. So even though the S&P was down, the internals look a little bit better. The new highs minus the new lows were positive, and then the 50-period moving average continues to go up. And we're also going up with this is that same chart, but a little bit bigger of the 50-day moving average of the new highs minus the new lows. Still getting a pretty extreme positive reading with the 10-day average of highs, lows for the S&P. That's showing good intermediate to somewhat long-term momentum is positive. Not really seeing any disconnect between the S&P and the NYSE advanced decline line. And we're going up with the NYSE cumulative advanced decline line based on price. The regular advanced decline line for the NYSE is also breaking out to a new high. This other NYSE advanced decline line is also breaking out to a new high. We break it out based on common stock, setting a new high based on price and volume. And volume is actually looking a little bit stronger than price. The new highs, new lows were giving us a positive reading. So our 50-day average continues to go up with the new highs, new lows for the NYSE. Then we look at a broad market measure of a 5-period moving average of the highs and lows, still getting a very positive answer there. Looking good with the advanced decline line. We were up with the NYSE common stock, the S&P, the mid caps, and even the small caps. And coming back and looking at our 20-period moving average study of those stocks inside of the S&P, we're back above 70 now, showing some good momentum, even though the S&P declined. So here are the stocks above their 20-period moving average, going up and above 50. That's positive. The 50-period moving average study is positive, and we're getting a little extreme now with the 100-period moving average study and with the 200-period moving average study. So shorter term, we still have more room to run. With the 100 and 200-day moving averages, we're starting to get extreme here, but we could still go higher than where we're at right now. Here's the daily chart. Not really much to pick out because we're not near a pivot point right now. We really dropped off to below average with volume. The condition of the 20-period moving average, we're coming down below the green line, but we're still above the red line here. So it's still holding up. Both lines are still going up for the time being, and we're still above the simple and exponential moving averages based on 20 periods. So the short-term trend is still positive. We went back up slightly with the 20-period moving average. We're extreme with the 50 and 200 when we measure just the S&P 500. We declined, but we're still extreme positive with the Stochk RSI, the Williams percent R. The CCI 14 is underneath 100. It's not extreme, just barely above 100 with the CCI 20. And the stochastics in the short, intermediate, long term, even though they're rolling over a bit here, they're still extreme positive. The force index declined, but is still positive. And we came down into a little bit further into the +2 channel with our standard deviations chart. Intermediate term, we declined, but we're still positive with the balance of power. This is the condition of the 50-period moving average, still above both lines, and the red line starting to come out above the blue line. The go, no-go system is still positive. The highest high value is still positive. The TTM squeeze is positive, and we're getting a little close to this black line here. If we go above that, that's a line that I put on here, so there's nothing magical about it. It's just kind of a visual reference point. We are still positive with the ease of movement. We're positive with the Erin indicator. We crossed back above 0. This was a warning sign yesterday. We're turning back positive with the S&P McClellan oscillator. So now we're starting to try to turn back up based on price, and we never did go down based on volume. So that is encouraging there. And after going negative with the NYSE McClellan oscillator, we're back above zero. So now we're starting to go back up with the summation index based on price and volume. And here's something that we've been concerned about, but now we're turning back up with the Swenlin trading oscillator based on price and volume, and we're above zero with both. So that's encouraging as well. Momentum is still positive for the PMO. Now we're a little bit concerned here because we're dropping below the moving average based on price. We're still looking pretty solid based on volume. So the volume part, that's positive, but the price turning down, that's slightly negative. We went up slightly with the PMOs that are rising. We're flat with the buy signals, and we're extreme positive with the PMOs above zero. We continue to be neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're extreme positive, but still positive nonetheless with the slope oscillator. We're positive with the MACD. And this is in the wrong spot, but the Sean trend meter is extreme positive. Here are our oscillators. We're still looking pretty positive in the short, intermediate, and long term. The Copic curve is also saying that momentum continues to be positive. We're above all of the plotted moving averages here on the chart, and we're getting really, really high with the bullish percent index. At some point, this is going to have to come down. It can only go so high. It's on a scale from 0 to 100. So we'll just have to see how this goes forward from here. We're still looking quite positive here with the NYSE bullish percent index. We declined, but still positive with the NASDAQ 100 bullish percent index. After being extreme with the money flow, we now declined a little bit, but we're still positive there. We're going up with the ultimate oscillator and above 50. We're above the advancing moving average with on-balance volume. We're still in the 50 area here with the RSI 14, and after being somewhat extreme with the RSI 9, we did decline slightly. And we're still looking better here with the Ichimoku cloud. The blue line is going up above the red line. We came down a little bit here with the green line, but overall, this is still looking quite positive. And the weekly chart, we're still well above this R2 level, a pivot point there. That's positive. And on a trending basis, we're still positive with the hike in ASHI. The Kegi chart is still positive. The Renko chart is positive, and the three-line break is positive. Long term, we're above this red line here with the 150 and 200 period moving averages. But as I always say, this also could suggest good long-term momentum that's positive. We're positive still on all time frames, on all indexes with the Keller market model. We're negative in the short term with bonds based on price. We're positive with commodities in the short term, or we're negative in the intermediate and long term. We're still negative across the board with the dollar on all time frames. And we had three sectors that were down: healthcare, which is defensive; materials, which is more economically driven; and tech, which is a real driver of the market. And this is what led to some disappointing results for the S&P index itself. And we saw mostly green or blue, depending on what you see here. The Dow set another new all-time high, but it didn't really stay there. The NASDAQ got above 18.2, then it went down below 18.1. We had the BPI with the S&P above 80. Okay, now we start to get extreme when we measure it above 70. Now it's getting above 80. That's pretty extreme, but for the time being, it's still taken as positive. Healthcare, which is a defensive sector, is also crossing above 70. And discretionary, we want to see this. We're crossing above 80 here. That's a very high reading for the BPI. And not really seeing any disconnect between the S&P weighted and equal weight indexes here. We declined a little bit as the equal weight had a little bit better day than the weighted version. And we came up, set the high with the Dow, but then closed kind of near the low. We were still up 1/3%, but well off of the highs. We continue to be neutral with the diamonds for the Elder's Impulse system. And we were down 0.39% with the NASDAQ, but still looking okay, but not coming back and setting an all-time high, at least yet. We were also down over 0.5% with the NASDAQ 100, also not setting an all-time high. We've gone from positive to neutral with the QQQs with the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be positive. And we're up 0.75% with the small caps, but we still haven't broken out above these previous highs. And we continue to be neutral with the small caps when looking at the Elder's Impulse system. When we look at the Russell 2000 small caps, we're still above 50 with the RSI. That's showing better momentum, and we're above the 50-day moving average, rolling over, but we're still positive with the shorter term momentum. Mid caps were up 0.11% and just having a hard time breaking out above these previous highs here. And we're still neutral with the Elder's Impulse system for the mid caps and down slightly here with the Wilshire. Really didn't change all that much after setting an all-time high on Thursday. Also down a little bit with the total US stock ETF after setting an all-time high on Thursday. The financial sector was up 0.29%, not an all-time high, but still looking solid. And we're continuing to go down with the staples to tech ratio. If we're more positive on the market, that's what we want to see. The warning sign here is that we've seen a recent golden cross with this ratio showing that staples are starting to trend positive when compared to tech, but we're just not seeing any real fallout of that, at least yet. The FANG index was down 0.64%, but still above its 50-day moving average. We're still below this short-term trend line, but above this longer-term trend line with the FANG index. Apple was up 0.12% above its 50-day moving average. Microsoft was down 0.75%, but still above its 50-day moving average. And we're concerned about this potential death cross here with Microsoft. Also seeing a potential death cross with Amazon. Still could take some time to play out. It was down over 1.5%. Meta was little changed and still looking pretty solid there. Nvidia was down over 2%, but still above its 50-day moving average. Tesla was up 2.45% and looking actually pretty solid. And this going up, this is why the discretionary sector has been doing better. It's mainly to do with Tesla coming back slightly above its 50-day moving average with Google, but we're also concerned about this potential death cross here. Netflix was down over 0.5%, but still above its 50-day moving average. And seeing a little bit of a weakness when we compare US stocks to world stocks, but longer term, the correlation is still strong. We're dropping a little bit more here below 70. We fell, but we actually were up in Friday's session to 68.18 for oil. We're mainly watching this for geopolitical reasons. The dollar continues to be in a downtrend, but is still above the 100 level. And we were down with the 10-year yield based on the yield here. We were up with the 10-year based on price and seeing a little bit of improvement here, even though it declined with Qs to S&P. We're still above the moving average. Discretionary is actually looking a little better here. We declined back down to the moving average when we compare large cap growth to large cap value. So a little bit of a turn down, but above the moving average with the large caps, looking okay above the moving average with the mid caps and coming back down to the moving average with the small caps. We're still overall seeing this ratio going down with the S&P to utilities. We want this ratio to go up, showing that the S&P is outperforming utilities, and we're not really seeing that right now. We want this ratio to go down, staples to S&P. It seems to be kind of ticking around sideways now, but overall it has been declining, which is positive. We want to see this continue to decline to be positive for the S&P. And then just an update of the Hindenburg-Ullman chart. There's been no change here other than the passage of time. But there's also a one-day lag here. This is actually for Thursday. So what's our outlook for Monday? They haven't really changed anything here. We're still positive, but we have this Hindenburg-Ullman and weak seasonality that are in the background, but they just have not started to play out, at least yet. We're going to get the Chicago PMI in Monday's session and then all the geopolitical things that may impact the market. Here is the economic calendar for the upcoming week. Big report on Tuesday will be the ISM manufacturing. We're also keeping an eye on the jobs numbers that are coming out because that's the area that the Fed is kind of focused on and what the stock market is focused on as well. On Wednesday, we'll get the ADP employment change, weekly jobless claims on Thursday, and ISM manufacturing. And then the big report is going to be the employment situation report on Friday. And here's another look at the previous readings and the forecast for the upcoming week. Just one thing of note on Monday, Chair Powell is going to be giving a speech, and when he talks, the world listens. Seasonality here for September 30th, we're negative with the Dow and S&P, quite negative actually, where we're neutral to negative with the NASDAQ. And this is another new chart. It came from Isabel Net blog charts here, and I have it highlighted here around September. And this just looks at the monthly return stats from 1964 to 2023, where September tends to be negative. and it's only up 45% of the time. And then they've got the best, the worst, and the standard deviation. We're kind of focused more on this colored area over here on the left side. And then this will be for, actually, never mind. We're way over here on the right side where we do see some positive seasonality according to this chart when we look at the Stock Traders Almanac. I have the new chart for October coming up, and I thought that's what popped up here. And Monday, at least in 2023, was the most positive day, and it's the third most positive day in 2024 thus far. We do see some potential weak seasonality here, but we're running out of September, and we really haven't seen that weak seasonality. We're also not really seeing it now yet. That's why we don't front run these things. We just use it as a guideline, the pirate code, and then we wait to see confirmation in the charts, and it just hasn't been showing up. This is the new chart for October, looking where we see some weakness. We look at the green dashed line. That's the S&P 500 during an election year, where we see some weak seasonality, a little bit of a bump in the middle of the month, and then things go down, and we tend to finish a little bit better in the month of October. And then looking at October, we're just like September, it's 50-50. Going back to 1950, we're up 9 out of 18 times. We're down 9 out of 18 times, but the average return is negative 0.9%. So the warning signs, we still have this omen and seasonality in the background. We're keeping an eye on the defensive areas of the market. Now, they still are holding up, but they've been holding up for a few months now, and it hasn't led to a real defensive move in the market itself. But we always want to be aware of that. Growth of value could be doing better. We were seeing a bit of an improvement with the S&P, but not so much now, where discretionary to staples is showing some improvement there. The positive signs, we're looking a little bit better. We're concerned that the Chaikin oscillator is declining. Chaikin money flow is flat. Accumulation distribution could be extreme positive, but it's still positive that way. And we're pretty extreme with the 5-period equity put call chart, but it's still going down, and that's positive. And the 10-day chart's going down, which is also positive. The advanced decline line's looking good. Both the S&P and NYSE McClellan oscillators have turned back to positive, which is making the summation index be positive. And our oscillators for the S&P are positive, including the Copic curve. The Swenlin trading oscillator, after being a little sign of concern there, at least for right now, that seems to have gone away and is looking more positive instead of giving us a little bit of a concern. The parabolic SAR is positive. The bullish percent index for the S&P is pretty extreme right now. The NASDAQ 100 is positive, and the NYSE bullish percent index is also positive. The vortex is positive, but we're watching that red line. It's getting extreme negative. The money flow is positive, ease of movement, and the ultimate oscillator are all positive. The momentum is measured by the PPO is positive for the NASDAQ 100, and the financial sector is still positive. So our conclusion, haven't changed anything here because we haven't really seen much of a mix-up yet. When we look at everything, we're positive, but we have these negative things in the background, the Hindenburg omen and weak seasonality, but they just have not materialized, at least yet. And we're still looking positive, a little bit shorter list in the short term, but it could suggest still good momentum. Intermediate term, we're wondering if the omen and seasonality are going to come in and make a difference there. And in the long term, we continue to be positive that way as well. So thank you. I hope you have a very good weekend, and I will talk to you in the next video.